Hello and welcome to the channel. My name is Patrick and today we're going to talk about not fearing the bear. You might have heard me sometimes say that I do not intend to take any shorts when we have the potential bear market coming. However, what I will say today might shock you even more. I do not take shorts, I'm actually planning to take longs. And now you might be thinking, what kind of mushrooms did Patrick pick in the forest this week? Well, don't you worry. I will explain exactly what I'm meaning, but first out, no financial advice on this channel, just me sharing my own thoughts and ideas. Let's look at its statement fact-based. I will show just a very simple three-step process that you can use for pretty much anything. And first we need to establish the facts. And what are the facts? Those are things that can't really be debated. If we have numbers in an Excel sheet, if we agree upon that here are the facts, those are the numbers in this Excel sheet, so that are the facts. From those facts, we could draw information. And even though we might be looking at the same facts, the same numbers, we may actually draw a different type of information from it. And once we've been drawing information from it, the next step is to form an opinion to base a decision. And whenever you have a problem, simple or in particular complex, try to divide it in these three steps. So you agree upon what are the facts, what information can we draw, and what are my opinions, decisions, or feelings maybe about this information. Because believe it or not, quite often all of these three steps are skipped. I see that in technical analysis pretty much every day. Now there's one exception where you should not use this process. And that is if you are in a relationship and you're the guy in that relationship. Don't matter what the facts are, you're always wrong. Just remember that. Let's get started and I will show you what I'm meaning. Let's start to look at the 2017 bear market. This is a chart from 2017. And let's assume that I'm a super good trader, so I will now short this market, every swing of it, to maximize my profit from shorting. So I start with shorting the top, and this is a little bit theoretical. We are like on the millimeter, on the inch, shorting the top, and then selling on the bottom. So here we have a drawdown of 43%. Then we find a next good top, and once again we are 100% accurate in all our trading. So we short this move as well, minus 65%. We keep doing the same throughout the bear market of 2017 as an example. Here you can see we end up with another minus 46%, and one more time we're shorting the top again and we have minus 41%. Now I said my plans are to take longs in the bear market, and this is where you might be a little bit surprised. Let's look here, for example. If I was equally good at taking longs as short, I could take a long at the first dip here and then sell on the first top. And here is where we need to look at the facts, because I've said sometimes we need to stop doing toddler technical analysis. I know that can be a provocative statement perhaps, and I said it the last time when we looked at chart and we draw a banana and we are saying that this is not sustainable, we're going up too fast, it needs to come crashing down. Well, it depends entirely on the scale you're using. So there's no fact in it. It's just completely based on feelings. If you feel that, you just draw the scale. Here we have a similar situation. When we look at this, it looks like it's much better to take short all the time than take longs. But what are the facts saying here? Because we can all actually calculate the facts. It's not even that difficult. And maybe I'm insulting toddlers. I think they can do this calculation, but at least babies cannot do it. The up move here is 54%. So in this first correction in the 2017 bear market, where we had quite a heavy bear market, the first short we could do took us minus 43%. And the first long we could do, if they both are perfect, was an up of 54%, namely more. And then look at the next one here, where we dip down 65%. How on earth are we going to beat that? It can't be possible, right? Wow, can this really be true? Is that move up 99% up? Well, actually it is. And the reason for this is, if we take an example, we start at 100 and you drop down 50%. where do you end up? At 50, right? If we now go up 50%, where do we end up? At 75. So you can see we need much smaller moves up to cover the same relative distance. Because if we go from 50 to 100, that's 100% up. But 100 to 50 is just 50% down. And it's this trick of the math that many don't think of when they draw charts and when they plan their trades. This is also one of the reasons why buying the dip is so powerful when you work with a volatile market, because the difference in the down and up increases. Let's keep looking here. Then we have another drawdown of 46%. If we took a long there as perfect as we took the short, once again we're up more than we have the downside, namely, and then the last one here will be up 47%. And shortly after this, we had a new dip, and then the new bull market ran. So if we took a long in that dip, of course, we will be up loads. But let's not just look at 2017, let's also look at the previous one in 2021, just to get a feeling for if it matters which bull market we look on. And of course, we don't know how the next bear market will look. But if it looks anything like these two, and it might even have less drawdown than any of these two had, I think these two is a good approximation. Here we have a first crash, minus 55%. Then we did have a higher one, so here everyone can agree upon it was good to take a long. But most people don't think about the difference, that this drawdown is 55% down. Visually, it looks like the uptrend is slightly more, but it's more than double as much. It's 139% up if you took that trade. Then we have a down, 52%, and yeah, look here, only 46% up. But this is pretty much the only exception if you're trading these bigger swings. And even if you go in and trade the smaller swings, you will end up with the same result as here. Then we have 68% down, and then we have a very small up that can't really help us out, can it? Whoops, it 108%. Once again, it's this thing, let's say you go from 100 down to 25, and then from 25 up to 50. Then you go down 75%, and then you go up 100%. So very small moves up become large percentage-wise when you go up again. And after this, and this is actually not even true, because this 108% is if we saw this first top. The minus 68% is actually the bear market low. So we could have kept this trade all the way until today, which of course will up several 100%. But you can see in both bear markets we have had, it has been better. If you could do perfect trades, it would have been better to keep longing the corrections than to keep the drops. And that's something that I think is a surprise for most, simply because they have not looked at the facts. This 3 steps method is so critical. The facts, what information do you draw from it, and then your opinion and decision. Most people jump straight to opinion without looking at the facts, without even trying to figure out what information they can draw from those facts, which could, by the way, be different. With the same Excel sheet, we could draw different information. That is the way of it. I'm sure a professor in mathematics and a doctor in history will see 2 different things if they look at a chart from Excel, for example. But that doesn't mean the facts are different. It just means the information you extract from it is different, which will then impact your opinions and thoughts and decisions from this information. And there's one other thing that is quite interesting with this approach, and that is that we don't know, or at least in my humble opinion, we don't really know how far this bull market will be going. So if we assume that the bull market is over, we start to short, and it turns out that we're in a prolonged bull market, a super cycle that will just continue for another year or even more. Well, then of course we sit in a perfect, super good position, because we have been buying the dips. Even if it's a bear market, those dips will be better buys than trying to short the tops. If it flips around and become an extended bull market, well, we're then sitting in the best position ever, because we just bought the dip into this extended cycle. Well, there you have it, the simple facts behind why I keep saying I don't plan to short Bitcoin. In fact, I plan to long it regardless of where Bitcoin is going. And it's based on this 3-step method. And I will come back with more videos on these 3 steps methods. And I will come back provoking people by saying, if you do not use this 3-step method, you're doing baby technical analysis. it's not really working. It's totally based on your own biases, feeling, and emotions. You just change the scale, you change something. It looks like you're doing fact-based trading, when in fact you are not. And when I say you, I don't mean my smart viewer community. I mean everyone else, of course. So thank you very much for watching today. Keep comment and all those things, and don't fear the bear. Hope to see you soon again.